In the report, you've mentioned that you're watching for signs of excessive credit growth, particularly in the housing market in Auckland, and that you've seen reports from the banks that have intensified their high loan-to-value ratio lending. What could or should the bank do if your concerns intensify?
Well, I think there's two aspects from which we look at it. One is what are the potential inflation pressures that are associated with rising house prices, and house prices picked up, I think, around 10% over the last year in Auckland, for example. But actual total credit lending, if you like, to the housing sector is still not growing especially rapidly. The other aspect that we look at it from is in essence around the prudential management side, and to what extent loan-to-value ratios are increasing. We have seen, particularly for first homeowners, loan-to-value ratios increasing in some of the banks. We're talking to the institutions about that, trying to understand their strategies better. We do have mechanisms if the housing market did at any point start to escalate too rapidly, then we do have mechanisms that we could come in and address that. But Grant, did you want to?
Yeah, I think that's a fair comment. I think the trend. I think there's not so much of a concern right now, but if the recent trend continues, then it could become an issue. I think the key in the housing market is to get the supply side going, because there is a supply shortage. It's not going to be solved by throwing more credit at it and pushing prices up further. And the more that happens, then the greater the risk is that eventually it could have a correction of house prices and damage in terms of credit exposure by the banks. So the household sector has continued to deleverage, and I think it's important for that trend to continue, and we're concerned if that was to start reversing.
What's your view on, for example, the Bank of Israel has introduced loan-to-value ratio limits, and the Canadian regulator has introduced loan-to-value ratio limits? What's your view on whether these should be the mechanisms used to address it if it does get worse?
I mean, I think the recent move by Israel was very interesting. I mean, they've got an economy that was essentially growing at around 3%. Like a lot of countries, they're experiencing upward appreciation in the exchange rate, but they also have a housing market that has been growing very rapidly, or price increases have been very rapid. I think of the order of 20% or something over the past year. And a lot of the investment in housing in Israel is by investors, if you like, owning second homes and the like. So I think the governor there, Stanley Fischer, faced a difficult choice, and that was in cutting interest rates in an effort to perhaps stimulate growth in Israel, and to also perhaps try and get the exchange rate down. He didn't want to see rapid growth in housing prices. Canada has also had very rapid growth in housing prices. They haven't moderated since the global financial crisis, unlike the US. When those measures have been applied, they've tended to provide some degree of relief for first home owners. So they tend to look more at people who are trading up in the housing market, or otherwise people who are owning second or third homes. I mean, potentially one of the instruments of macroprudential policy would be loan-to-value ratios, but we're still at this point discussing a memorandum of understanding with the Finance Minister and the Treasury. But at the current state of the housing market, it's not something that, even if we had the ability to use that instrument at this point in time, it's not something that we would seek to be exercising at the current time.
The only thing I'd add to that is just to remind you that the macro-prudential framework we're talking about, and we have mentioned 4 potential tools, one of them being LVR ratios. The objective of that policy is around systemic risk. So
yes.
we would have to consider, in order to use such a tool, that there was really a risk situation that was building in the banking system that needed, countering through macro-prudential policy that wasn't being handled sufficiently by the sort of micro-prudential tools that we use as a matter of course.
But it would give you some flexibility on the monetary policy side, given that that's how the Bank of Israel has used it. Shouldn't that be part of the conversation as well?
Well, it is part of the conversation. I'm just emphasising that it's the secondary part of the conversation. The primary one still has to be financial system risk. If you're using LVR ratios to moderate risk in the financial system, in all likelihood you would also be assisting monetary policy, but that wouldn't be the prime driver. That's all I'm saying.
Are you concerned then that too much hope or perhaps a misunderstanding about the role of macroprudential policy is emerging in terms of the debate about the dollar and the monetary policy framework?
I think that's right, because in a number of countries, and particularly if you look at the Asian countries, the term macroprudential policy really is being used as a monetary policy tool. Whereas if you go back to Basel and the true meaning of that policy, it is about macro-prudential. It's about reducing risk in the financial system that arises from macro factors, from the business cycles and credit cycles.
There was a decision by the bank to expressly keep the macro-prudential stuff sort of away from the monetary policy stuff. Can you elaborate on why that decision was taken then?
Well, I mean, the bank has 2 objectives: price stability, and with monetary policy aimed at price stability, and we have financial stability with traditional prudential policy aimed at financial stability. Now, when the macro-prudential, our powers for macro-prudential are very much under the Part 5 of our Act, and that gives us the power to apply macro-prudential policy, but for the purpose of financial stability. Now, we're very much aware that it has the sort of second round collateral effects, reinforcing effects for monetary policy, and we need to be aware of those, and the fact that we're doing both in the same institution, I think, assists in that regard. But all I'm saying is we need to keep in mind what the primary purpose is as we're using this.
You obviously decided, though, to keep it away from monetary policy. Did you look at the ability to use the macroprudential tools in the monetary policy sphere alongside the OCR?
Well, you have to ask the question, in what situation would you want to use a macro-prudential tool to, with a price stability objective in mind, if it was not consistent with financial stability? That would give you a problem, because then you'd be using a tool that was set up for financial stability for another purpose, and we just don't think that's appropriate.
I mean, in many cases, macroprudential policy will be consistent and be supportive of monetary policy. But you can think of circumstances where that wouldn't be the case. For example, let's say we had a positive productivity shock in New Zealand. Then you might find it appropriate to ease monetary policy. But on the other hand, as a result of that productivity shock, you could also see credit starting to grow quite rapidly in the economy. and potentially asset bubbles tied in with that productivity shock emerge. So they won't always be supportive of one another. So the decoupling, I think, is quite appropriate, particularly given the financial stability objectives of the bank.